Welcome, everyone. I'm Ryan Cummings.
And I'm Andrew Boudry.
This is the Your Bread and Butter podcast. Today's episode is Where We At and Where Are We Going?
The economy is a big part of what's going on. You should pay attention to it. We're going to handle all that today, what you should know, where we're going, and how we're going to get there. Stay tuned.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer. Member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Private Financial Design LLC are not affiliated.
Bread and butter.
Welcome back, everyone. In today's episode of Where We At and Where Are We Going, we're going to look at a lot of the statistical data coming out of the current economy. So a lot of things like unemployment rates, job market, labor market statistics, potential for recession, performance of the stock market. All these things that we're going to discuss and help try to interpret some of this data and how you can use it going forward in looking at the potential for future market occurrences.
Yes, and this is really important because, people always ask, we're at a party or even sometimes in a client meeting, they'll say, so where's the market going to go? Well, you can't predict the future.
Right.
So what we do have, though, are what we call lagging indicators. We have things that indicate some things, but only from the past perspective. So we're going to look at some time periods and some of the history around them to give you a framework, because this episode is a first part of a two-part episode of where we're going to want to move money to, or as a choice, if you want to move money there during an environment that we see developing, but there's no prediction of the future. So let's look at some past history and what's going on. Let's start with the 1940s.
Yes, we have the post-World War stall within the 1940s. So we saw some pretty significant changes in the economy, post-World War. There was, I think a lot of artificially high demand from things like defense spending after the war and, things of that nature. And the unemployment rates, approximately 4%. So nothing crazy, kind of similar to where they are now. We're seeing some similarities in that. And, but we eventually, saw unemployment start to rise. And again, a little bit mimicking what we're currently seeing. And that's what you'll see in a lot of these different examples that we're going to discuss today. There's some parallels to today's environment, and there's some things that aren't so parallel.
Every one of these time periods have lagging indicators, even like when we get unemployment reports today, that's past news. We get different job reports, that's past news of where we've just been. And in the 1940s, you kind of have to picture this a little bit. So the war ends about 1945 and have all these veterans coming back to the United States, all these new programs, new homes being built, first-time home buyers, veterans homes being built. We have new manufacturing. And we have, all of a sudden, though, we have this overbuilding of the economy where all of a sudden there's having to be actually some unemployment because they expanded too fast, and all of a sudden the demand slowed down after the war. So that's kind of a historical context, because we've had a market really for the last, 14 years? Our stock market has really kind of rocked and rolled through a lot of different scenarios, but it's had a lot of employment and a lot of movement in the economy. So we'll go on to the next little time of history that we can look at. 1957, big sharp downturn.
So the sharp downturn in the market in the 1950s, a lot of Fed tightening. So we're talking, raising interest rates, high inflation. So again, kind of similar to maybe not exactly today's environment, but we just recently had some, federal interest rate hiking cycle just a few years ago. And we're still seeing some lingering inflation. It's been a little bit of an increase. Now there's some other dynamics coming into the recent increase in inflation, but either way, inflation has been sticky over the last few years, causing the Fed to very slowly bring these rates back down.
It has. And after Truman left office and Eisenhower took over, we began this major highway construction during the Eisenhower era, where all of a sudden this interstate highway, all these veterans and these other people, they all got these jobs. But as we tail end towards the end of 58, those jobs disappeared. So we just actually had the, Build America Better from the Biden administration, and that money is all now kind of running out. And those things those projects are already done. So there are some similarities there, but the short period of huge drop of losses of jobs was dramatic, and it was policy driven too.
Yeah, and that's where this was a more modern style of downturn.
Right.
It was a very sharp decrease, a spike in unemployment. There's some sharp job losses that obviously resulted in that spike to unemployment. But it was a rapid recovery. It was a sharp loss of a lot of jobs, followed by a rehiring very quickly. So
you had about 10 years of between 48 to 57, 58, about 9-10 years where you had some stability in the economy as it recovered. But after 57, 58, it just boomed.
Part of that was, again, a lot of similarities here of higher unemployment, Fed tightening,
right,
inflation. So we're seeing a lot of these with each of these different scenarios, some similarities to today's environment.
Right. And as we go on to the next little area of time, I just want to make everybody aware of what inflation really is. You're never going to be able to get rid of inflation. Inflation, if you just think about it in simple terms, is tied to the fact that as the population grows, demands of product and services grow. And when you need more product or you need more services, you need to hire more people. You need to get more material. Those costs are not static. They go up as you hire more employees, as you hire or get more material to build your items. So things in inflation are part of a natural expanding economy.
Yeah.
It's a good thing.
In that sense, then what we're a lot of talking about in a lot of these scenarios is abnormally high inflation. That's where it's, we want inflation. We absolutely don't want deflation. That's the, I feel like that's always the dynamic that we're talking about with our clients is they're like, oh, prices haven't come down. Well, we actually don't really, even though it feel good for your wallet, we don't really want, from an economic perspective, prices to come down.
Yeah.
That's deflation.
Prices come down. Stagflation is what develops. And so my favorite little era is the 1970s, only because, yes, I graduated from high school 1976. Now you know how old I am. But here's the truth. The truth is I was around and very aware of what was happening in our government and the policies that were in place. And unemployment began to spike pretty much. And as we got into the 69, 1970, 71 era, we began to go into a recessionary environment as the Vietnam War was winding down. Unemployment began to grow significantly, and job losses became moderate, but inflation and the different policies to try to get America out of that recessionary and inflation environment were not helping. In fact, by the time we get to 1979, 1980, we have mortgage rates that are 16, 17% for a mortgage. Yes. The building values were smaller, but you take a $50,000 house at 18% mortgage, and it's almost like having a $250,000 mortgage today. So this dynamic has occurred before where we have this unemployment rising. We have a little bit of a recessionary environment with unemployment developing and getting, which, by the way, we are not having a lot of job growth right now, so that's part of it. But we also have inflation, and it's real. It doesn't matter where the inflation comes from. It can be an external source, like in the current situation we're in with the war in the Middle East is causing inflation to go up because of gas prices, but not everything's going up, but eventually it will. So that's the problem. So that's the 1970s.
It was a battle for the Fed of the common trade-off is, well, you could either have, low inflation and low job growth, or, higher job growth and higher inflation. You can kind of, balance out the two with some spending adjustments and some rate adjustments. But this is where the Fed was hitting that competing factor of, instead of them both being high or both being low, we were seeing high inflation and low job growth. Yeah. So it's a policy conflict, I guess, at that point is what the Fed was running into at this time.
And our next one is here in the dot-com era. Let's jump on that one.
Yeah, there was a very interesting dynamic here in the dot-com era. It was a driven a lot by overspending on the internet and tech investments. This was something that caused an overvalue in the stock market, and then eventually a bubble, a collapse in the .com sector, with leaving investors who were maybe overweight in that sector high and dry.
Yeah, so the Federal Reserve Chairman at the time, Alan Greenspan, said that the NASDAQ went up 89%. And he said, the market is experiencing irrational exuberance. Yes, it was a little crazy. And the truth was, there was a lot of money spent in tech, but there was also pretty significant, moderate but significant job losses. But it was a prolonged labor weakness, not being able to actually fill the right spaces in the right time. And in that era, everybody was investing in .com. It was, e-toys, e-bikes. Of course, now we know e-bikes are a little different. E-bikes and e-this and e-garbage disposal, and these websites just for buying all these little things. Well, it didn't work out that way, did it?
Right.
Now you got all the changes that have occurred.
And this was much more moderate.
Much more moderate.
We weren't seeing a massive spike in unemployment, a massive loss of jobs. It was a very moderate loss of jobs, but more of a, like you said, a prolonged period that saw those jobs somewhat stagnate over multiple years.
And some of it was, and you look back and you read some of the business journals, which I did, and they're thinking, well, because of the internet, we're going to lay off half of our people because the internet's going to do it for us. And those same companies 2 or 3 years later are having to hire back people because it was a disaster. So if you can run that comparison to AI, and people ever all worried about losing their jobs over AI, yeah, there's going to be some job losses. But what this shows from the .com era is that there is adaptation in the marketplace.
Right. And a lot of what this called, what actually maybe there is some similarities with today that could be a result of some AI is, it wasn't crazy job losses that we talked about, but it was more of a slowing of rehiring with those mild job losses.
Right.
And that was that was due to increased productivity, which that is a little bit of a risk of the investment in AI.
When you get slow job growth,
productivity.
It's going to affect everything.
Yeah.
Slow job growth does not really help a whole lot.
Right.
It really, especially for people's wallets when they're trying
Absolutely.
to afford living.
Absolutely. And then the next cycle that we'll touch on here is the 07, 08, 09 financial crisis. We saw a pretty steep recession, a severe job loss. So this was really the flip side of the last one. Much more extreme job loss, very, very high unemployment. And, a lot of it was triggered by this very fragile housing bubble that we had in those time frames with the subprime mortgages and banks over leveraging to unqualified or less than qualified buyers.
And this is where your economy is affected by a systemic shock. Our financial system was not really in good order. Some of these, the banks, and actually the majority of the banks, even the big national banks, got involved in this housing crisis without getting into too much of that detail. And this was a systemic shock to the system, meaning that was something within the system was broken within the capital market system. Since then, they've put safeguards up and they've rebuilt much of that. For all of you out there that think that, we as taxpayers bailed out the banks, we actually did not bail out the banks because the U.S. government bought stocks. Yes, it was with our tax dollars, but mostly borrowed tax dollars on short-term treasury notes sold to various countries that they then sold the stocks later on and paid off the notes. So for all of you people out there thinking that we all bailed them out, no, actually we didn't. The stock market did. So the housing and financial stress that caused was massive. And I do remember unemployment getting up into the high 8s, almost close to 9%, probably pretty close.
Yeah.
But but severe job losses. We're talking like overnight, 10,000 people gone. But our slow job growth now, that's concerning. Don't have the big job losses yet.
Right.
Right.
And then the other, I think, dynamic to point out within this financial crisis was the decline in home values.
Yes.
We did see that, which is a big part of our economy, a big part of our GDP and our stock market too. So we saw that component cause a decrease in the value of the economy and of the stock market during this time. But, I think the thing to point out there is, yeah, we had some, maybe propped up or higher home values, kind of similar to what we're seeing today. But today's housing market is not similar to what we saw in 08, 09. So I think all the people, sitting on the sidelines hoping for a housing market bubble to pop to be able to buy a home at a much more affordable price, there's not quite that same dynamic happening currently, and so much less likely for something like this to occur in today's environment.
And again, remember what we're looking at here is we're looking at the order of things. We're looking at history. And again, that's a lagging indicator. So we're going to talk a little bit now about currently where we're at, because we actually have what we would call a labor market stasis. It's stable, but it's also stagnant.
It is. We're seeing some slowing hiring for sure. Job numbers have been a bit up and down as of late, but more down than up for the most part over really almost a whole year now at this point. So we've seen some creeping unemployment, some slow, kind of similar to the 70s period that we were talking about of the not steep job loss numbers, but the slowing in the rehiring side of things. We're seeing a little bit of that dynamic coming into play. Part of that is maybe some relation to tariff uncertainty as over the course of the last year. Other parts of that are potentially due to still slightly higher, slightly elevated interest rates. There's a lot of different reasons, but we're seeing, at least from the job side, creeping up of unemployment very slowly, and some slowing of new jobs.
Yeah, payrolls are declining, and there's no official recession that we're in, but right now we're in a low hiring, low firing environment, and the outcome is uncertain. I mean, anybody that can tell you that they know the future of the labor market, there's a little 3-letter word that Ryan and I like to use with our clients when they come to talk to us about the investment that their nephew has, and it's RUN, run! Nobody knows the future. Nobody can understand that. But we're just giving you a basic understanding that these indicators that are measuring stuff from our past months are just giving us signs that you should be prepared for, to understand, so that you're not surprised, because, basically inflation is going to continue. You just can't, it's not just the gas pump that's going up. So when your gas pump prices are going up and diesel is, $2 higher a gallon right now for these truckers. So somebody's got to eat the cost of those goods being traveled by truck or train or wherever. Jet fuel is through the roof, right? Literally.
All fuel.
All fuel is all through the roof, right? But the point being is that cost has to go somewhere, because the oil companies aren't going to eat it.
Right.
They're not going to be like, oh, well, we'll just take on that extra cost for you guys. No, that's not how oil companies work. So the reality is we are in a situation where we're going to have inflation for a while. And I don't know that I see a whole lot happening with interest rates, but we are definitely in this stagnant environment. So let's talk a little bit more about that.
Yeah, the Fed's in kind of that, similar to some of the earlier stages we looked at. They're in that bit of that policy crisis. Maybe not full-on stagflation, but beginning to be stagflation-esque of having these competing things where, unemployment's rising, but so is inflation.
Yeah.
And so typically those, two give and take that I mentioned earlier, where the Fed hopes to maybe have, low unemployment and, low inflation, or high unemployment and high inflation. We're seeing this mixing of the two, where the Fed can't just necessarily cut rates to solve one without exacerbating the other.
Right.
And they're running into that dynamic.
Making it worse, for sure.
Right.
So I think the reality check for all of us is to look ahead and say, well, what can we learn from this past history and what we're currently in now, and where might it tend to lead to? And I think that's more important, to be prepared for what's there. So we're going to talk about it in our next episode, so I hope you'll pay attention to that. But giving you the historical background is very important. Sometimes people don't like to hear about history, but when it comes to the economy, there's a reason why economists don't like roller coasters. Do you know why they don't like roller coasters?
Something about the ups and downs?
Yeah, there you go. They don't like the ups and the downs. They don't like the curves. The economists, they just want it all leveled out.
It makes it predictable.
It makes it predictable, right. Exactly.
And that's what we're seeing today is a lot of unpredictability, a lot of ups and downs for sure. And when we look at a lot of these periods and start to compare them to today, there are some similarities. Again, not a guarantee we're going into a recession, but it is some signs that need watching.
Yeah, that's the number one thing. Recessions often begin when hiring slows before layoffs rise. That's not us saying that. That's the truth of history. Yeah.
Right.
And then next, unemployment typically starts in that 4 to 5% range just prior to a recession. Yep. That's kind of a big part of that.
And then you also see some payroll growth flattening. There's a kind of another early signal as we go into a lot of these different recessionary examples that we gave today, and potential for some policy tightening can contribute to downturns. And that's maybe something that we're a little less at risk for. I think in this time around, I don't think we're going to see too much of tightening. I think the Feds, like we're talking about, they've got their hands tied on both ends of this one. I don't think we're going to see tightening or loosening. I think we're probably going to see a little bit of a stasis here when it comes to the interest rate environment.
Yeah, and even though we're in a stall dynamic, it's unclear as to what the outcome will be, but in conclusion to this, you should really understand a few dynamics. So let's go on to our conclusion, and we'll talk a little bit about what you should be looking at. Key signals. Our current environment, we already know what it is. It's a rare late cycle pattern seen before in the years 2000 and 2007. And in historical context, 87% of similar periods led to recession within 12 months, but hiring typically slows before the broader economic weakness appears. Now, on that note, what some economists refer to as a late cycle, we're in that late cycle because we just had a fantastic 14 years, despite COVID. By the way, despite COVID, we still had a really, really good outcome over the last 14 years.
We did. I mean, including the COVID year too, was actually at the end of the end of the year was positive. So, like you said, very good decade and a half. And so we've got some of the post-pandemic, post-COVID labor dynamics kind of creeping in here, where we did have a little bit of a job loss during the COVID, beginning of COVID.
Yeah,
some pretty nice hiring after that, and we're seeing a little bit of a slowdown now after a few years of some pretty strong job numbers, some pretty strong hiring and growth in the economy, and then you tie that all in with a lot of the geopolitical risk going on right now.
Yep,
the conflict with Iran just creates some additional uncertainty, even though a lot of these conflicts, as we'll talk more about in our next episode, don't necessarily cause these recessions. They can accompany a recession and potentially, push things a little bit quicker into that path.
We also have the possibility of a soft landing, where you have a prolonged low growth period with gradual labor market, cooling, with sort of like, it's slow, kind of steady growth. But I think in order for that to happen, whenever that's happened, it's because we've had stability from the policy point of both the Fed and the executive branch, as well as the Congress, that there's a stable pathway to where we're going. And so any kind of chaos or disruption that is not part of that could make it a problem. Right now, we're not facing what we would call systemic risk, where there's anything wrong with the financial system. There's no banking issues. There's not any other, debt issues that are going on with the consumers. Yes, we do have student loans. Yes, we have a significant government debt, deficit. That is a real issue, but it's not what's affecting this current economic environment that we're in.
Yeah, I think the bottom line is that the economy's at a bit of an inflection point. I think the next 6 to 12 months will kind of tell which of those directions we go. Do we see maybe some resolution with this Iran conflict, maybe some cooling of inflation, and maybe experience that soft landing, or we experience a little bit of the opposite, and the negative job numbers continue to pile up, inflation continues to creep up, and we see a bit of a stagflation / recession type scenario work its way through into 2027.
Yep. Well, we hope you'll tune into our next episode that is tied right to this. We're going to talk a little bit, how do you invest through this? And actually, we think that will be something very helpful. If you've watched this episode, you'll understand the dynamics of where we're coming from. So thank you for watching us today. And always remember, Live today for the tomorrow that's in your heart.
Because you'll never have more time to invest for tomorrow than you do today.
Thank you for being with us.
Bread and butter.